Good afternoon. I'm going to give it a minute just to let some participants arrive, and then we'll be starting our masterclass on sustainable finance. Very excited about this, a brilliant panel, but we're going to give it a minute before I jump in and start to make introductions. Okay, so we'll make the introductions as the participants start to come in. Welcome to this masterclass. This is, I think, the 6th and the 7th in our series. Very excited for this one. It's on sustainable finance, looking at the market for sustainable finance, how that's developing in Australia, and the challenges and opportunities faced. First, I'd like to show my respect and acknowledge the traditional custodians of the land, of elders past, present, and emerging, on which this virtual meeting takes place, which means we're really recognizing elders across the whole of our lands and in New Zealand. And for me, though, that's the Camaragal people in the Daru country, which is in the North Sydney area. But it's extending acknowledgements to the custodians of the land on which you stand. Very exciting panel today. I'd just jump across and introduce each of you first, and then I can talk a little bit about the topic and jump into questions. First off, we have Sushila Perez da Costa. She's head of advisory at Regnan. Sushila has more than 15 years domestic and international experience advising institutional investors on responsible investment. She was instrumental in the development of Regnan's research products, stewardship strategies, and advisory programs, and has led or overseen much of this work in her previous roles. As head of advisory, she has assisted small foundations through to the world's largest institutions, including a successful 18-month project in Switzerland, advising on responsible investment lending for a global full-service bank, as well as providing strategic advice to the UN-backed Principles for Responsible Investment and Upgrading Stewardship. Sushila chairs the Responsible Investment Association of Australasia and is a special advisor to the co-chair of the Australian Sustainable Finance Initiative. She holds a Bachelor of Arts with honours degree from the University of Sydney and a master's degree in communication management. And she's also a licensed certified investment management and analyst professional. Very impressive. It's great to have you, Sushila. Our second panelist is Stuart Cormack. He's a partner at Gilbert and Tobin in the banking and infrastructure group. He has experience across a broad range of areas in banking and finance with a focus on leverage and acquisition finance, unitranche, which is a new word I haven't heard before, Stuart, and institutional debt financings, general corporate lending, sustainability linked and green lending, infrastructure, project financing and PPPs, and of course, real estate financing. Stuart started his career in Gilbert and Tobin's banking infrastructure team in 2010, but he's also spent 3 years in the banking team at Linklaters in London, where he became a managing associate. Stuart's 3 years at Linklaters also included a secondment to the commercial and syndicated lending team at the Royal Bank of Scotland, and he returned to Gilbert and Tobin in 2017. Great to have you on, Stuart.
Thank you.
And our third panelist is Michelle Sim. She is a practical guidance senior legal writer in our team at LexisNexis, but she has extensive experience in private practice. She's advised lending institutions and corporate borrowers on a wide range of domestic and cross-border lending transactions. She has also previously worked at Ashurst, advising on corporate finance, leverage and acquisition finance, real estate finance, debtor finance, and distressed debt transactions. Michelle also has experience at a leading financial institution as an in-house commercial legal counsel, and she holds banking and finance qualifications with honours from the University of Melbourne. Michelle, it's awesome to have you here as well.
Thanks, Greg.
So, great panel. And I'm very excited to jump into the conversation around sustainable financing. What's great is that we've got Sushila really from the investment side. Stuart's really, you've been advising people from the client side. And obviously, Michelle, you've done a lot of research in this space. But before we jump into it, I'd just like to get some input from the participants, from you, the audience, as to what's happening with ESG in your organization. So if we can throw up the polling question. And this will help us feed into the conversation. So the polling question, in my organization, ESG is neither 1 being no at all, 5 being extensive. So just choose for you. Neither shareholders nor partners nor staff allocate any priority to it. Shareholders, partners pay lip service to ESG priorities. Shareholders, partners drive some ESG individual and organizational goals. Shareholders or partners are focused on our ESG approach. It is tracked frequently and a driver of some of the major objectives of the organization. So if you can jump on and put your vote into one of those, so we've just got an idea of our audience, that would be great. Okay. So first off, let's just have a bit of a macro view. So you can drop that. Thank you. Drop the poll. Thank you. First off, let's just have a bit of a macro view. Sushila, maybe I'll throw it to you. Has the market for sustainable finance been tracking in Australia? I mean, what is the market looking like and what's happened over the last COVID period and before?
So it's almost impossible to overstate the growth, both in flows and enthusiasm into the sustainable investment market. Just last week, the Responsible Investment Association of Australasia, which is the peak body for our region, released its annual benchmarking survey, and it found that it was $1.281 trillion that are now invested in some form of responsible investment across Australia. And that's up 298 billion from the previous year. So a quarter of that has flown in the last year. At the exact same time, the remainder of the market has actually shrunk. So the non-responsible investment parts of the market have shrunk, while the responsible investment part of the market has grown significantly. I've been a part of the organisation, RIA, on its board for about a decade. And in the very earliest days, we used to have objectives around growing the responsible investment market, growing interest in the field to kind of, can it one day be 2% of the market? Could it one day be 5% of the market? Obviously, size is no longer the relevant benchmark. And so it's probably no surprise that it's turning the attention to quality now is really the focus. The growth has been phenomenal.
And Stuart, have you seen the same on your side?
Yeah, look, definitely. And I mean, I primarily look after loans, I suppose, the corporate lending for banks, borrowers, other institutional lenders. And I think there's been an absolute explosion in that space of ESG financing or sustainability linked financing in particular. So for many years, we've had green lending products in the market. But they were a bit limiting in terms of who could access them because they were really use of proceeds instruments. And so, you know, to the extent you're a wind farm, that's great. You can do a green loan, and there was always appetite to fund green use of proceeds type instruments. But if you were a borrower who didn't necessarily easily fit into a green project category, then there wasn't really an option for you. Now that has changed in the last couple of years with the emergence of, in particular, the LMA, APLMA, LSTA sustainability linked loan principles, which now provide a general corporate purposes lending instrument which incentivizes ESG outcomes by offering, you know, margin ratchets up or down depending on your performance against certain set sustainability KPIs. That has led to, I guess, a real explosion of enthusiasm and interest, as Sushila mentioned, on both the borrower and particularly on the lending side. We've seen pretty much all of our bank clients massively gearing up their capabilities in this area, either through moving kind of very senior bankers from elsewhere in the institution to head up these teams, you know, showing what a priority it is, or through bringing in know-how from other markets where these products are a bit more developed, in particular Europe, and to a lesser extent Asia. And we can tell that it's a priority for these banks. That speaking to one of my clients at one of the big four, they essentially every time they pitch to a corporate borrower now, they send a sustainability person or have a couple of slides on sustainability financing in their deck. So there's a huge amount of appetite to deploy these products from the lending side. The borrowers are also very keen to get them, not just for the margin benefits, but also, I guess, the positive marketing benefit that you get from, you know, being a participant in a sustainability linked loan. I suppose that the thing that I'd say, Greg, and I think we'll get to this in the other questions though, is that whilst there's a huge amount of enthusiasm in particular sustainability-linked loan space, that hasn't necessarily translated into a huge number of sustainability-linked loans actually closed in the corporate lending space at this stage. And I think we'll kind of draw out the issues as to why that might be the case. I don't think it's going to stay that way forever, but in the time that we've seen this product in the Australian market, there's probably only been about 15 to 20 deals done at this stage, which is not representative of the interest in the product.
Just throwing back to Sushila, just a question on that. If you've seen the volume, where's it come from if it hasn't been on the corporate side? You're muted, sorry.
The responsible investment field obviously includes a lot more than just what we would see as bonds. So Stuart's obviously talking about lending. By the time it reaches kind of my part of the supply chain, that's a bond. But equities is a huge part of it. Direct property portfolios are a huge part of it. There are a whole range of other asset classes that feed into this. And of course, the international market's also very attentive. We've seen new regulation come out of Europe that effectively drives a much greater focus on responsible investment products than ever has been the case before, with the SFDR regulations there. And so there's a huge amount of demand coming from people who have money that they want to invest responsibly.
Yeah, that makes sense. Michelle, I'll throw it to you if any comments on this particular question, but also we will talk about sustainable finance and sustainable investing. What is the difference, would you say?
Yeah, well, look, just to pick up on both Stuart and Sushila are saying, we have seen a real, rapid growth globally and perhaps to a lesser degree in Australia, but there's really a rapid rise there. And I think, picking up on the point of quality, the focus on quality, and I think banks are very concerned about, maintaining the integrity of the sustainable finance market. Lenders being very cautious about making sure the criteria for those products are, strictly applied. And, to Stuart's comments, it does mean that a proportion of corporate borrowers won't be able to meet that standard. But I think the sustainable, finance market in Australia, given it is in its early stages, in a rapid growth stage, I think that sort of cautious approach is important and something we'll continue to see more of. And I suppose sustainable investment versus sustainable lending, just generally, in terms of broad umbrella terms, I think on the investment side, you're looking at, really stakeholders wanting a piece of the equity in, organisations who are taking responsible sort of climate-related action and who have ESG, credentials. And in the lending space, there's, I guess, two sort of different types of products. So you've got your green lending products, which, as Stuart said, they go to the, the purposes of the loan need to be applied to green projects or, the wind farm or green building, for example. Then on the other side, you've got your sustainability linked products, which actually incentivize improvement in a company's sustainability performance by way of pricing discounts when you actually achieve the agreed sustainability targets. So it's definitely a space that's really growing.
A complex space as you unpick it. Just a reminder to the participants, there's a Q&A. Please drop in any questions you have, and I will make sure that they're collated and I'll ask that of the panelists. Stuart, flicking to you. So you did start this conversation when you in your last comments. But what do you think are the main challenges that Australian corporates face? Because you said that very few of them actually end up closing, as much as there's a high demand.
Yeah, look, and I should clarify, Greg, I don't think that is necessarily a fatal flaw with the product or the areas. I think it's just that it is a fledgling area in this market. And, whilst there's a lot of, I guess, capability that's been built up on the lender side, the capability or the ESG understanding and ability to implement these structures on a corporate borrower side is probably not quite caught up to that as yet. But if you see the success of these products in other jurisdictions, particularly in Europe, I think, you know, that's a snapshot of where we'll probably be in 3 to 5 years. I really think that, you know, in 3 to 5 years, almost every loan will be a sustainability linked loan or have aspects of it, you know, to the point where you may even see, you know, there's not even a margin benefit provided for good ESG performance. It's just a margin penalty, you know, so you're paying more for your debt if you don't hit the baseline standards that people would expect. So I do think we'll get there. One of the reasons I think, you know, we haven't seen as many deals closed in this space in the last few years is just I suppose that you have the APLMA principles, which basically provide a pretty flexible set of you know, ideas that need to be picked up when you're implementing these structures. But as a result, you don't have any kind of standardized documentation, any kind of standardized KPIs, anything that can be kind of readily commoditized and rolled out across the debt capital markets generally for, you know, one borrower or another. And so actually structuring these transactions and getting them to a point where a borrower is happy to be subject to these reporting obligations and, you know, with you know, actual pricing implications, but also lenders are willing to lend into these products and, you know, get the benefit of branding them that way, mean that there's quite a little bit of work to be done in setting them up. Now, the actual loan documentation itself is never challenging. I mean, that it's all very mechanical stuff. But if you're a borrower and you don't already have well-developed sustainability function or ESG function in your business, you know, whether that's, you know, having really clear guidelines and policies and targets internally already, quite apart from what you're doing on a ESG financing perspective, you know, maybe having a dedicated person at the company who looks at the sustainability aspects of the business as well. You know, some of these things can be quite hard to implement when you come to do an ESG loan or a sustainability loan. And so we've had quite a few initial chats with corporate borrowers who say, oh, I've read about these products, they sound great, I want to do one. And we say, okay, well, you know, what's your sustainability policy? Oh, we've got this page on our website and it, you know, okay, well, you're going to need something much more robust than that, you know, and then, okay, and who looks after your ESG, you know, objectives? Oh, well, CFO does a bit, the general counsel does a bit, you know, we kind of manage it between ourselves. And, you know, that's not to say that you couldn't structure one of these products around a company like that, but when the lenders come to lend to these products and basically go out and market these products, you know, as a sustainability coordinating bank, that they want to have a structure and rigor and process around the sustainability KPIs. And in fact, the APLMA principles, the two essential requirements of a sustainability linked loan is regular reporting on your KPI performance and external review, right? And, you know, if you don't have well-developed ESG functions and policies in place already, it's almost impossible to meet those two objectives. So I think, you know, part of it is going to be the development of this product is going to be the natural development within corporates around Australia of their ESG functions for reasons that have nothing to do with sustainability financing. But once that capability is developed, the policies are in place, they've got the dedicated people working there, it's going to become much easier to just build a sustainability financing product around the framework that they've put in place.
Yeah, that makes sense. So Sheila, would you say, does that sort of limit, or at the moment limit it more to the larger organizations as a result, because they don't have those functions in place yet, especially small businesses?
Certainly a majority of the instruments that I come across that, you know, investors I know are putting into their portfolios are from large listed companies, whether on the debt side or on the, you know, indeed on the equity side. The resourcing is heftier for smaller companies that are retrofitting sustainability.
Yeah.
Which goes back to kind of the earlier comment that Stuart was making. There are companies that are very naturally sustainability plays, and that's not a retrofit, you know, if you're a wind farm, for example. when you don't need to retrofit, it tends to be built in. There's a less hefty resourcing load there, but certainly for the larger companies, it tends to be an overlay over the core business. That can absolutely favour organisations, especially when it comes to issuance of instruments. It can absolutely favour the larger end that is able to resource not only the doing, but also the disclosure elements of that, the assurance processes that go around that. But it's not always the case. So certainly on the equity side, where it's not so much about issuing an instrument, but rather being recognised as a firm, such that sustainability-minded portfolios are more likely to have your firm included within a portfolio of securities. That doesn't necessarily take the same degree of resourcing that issuing a new instrument would do.
And I should say, Greg, I mean, that's not to say these products aren't available to SMEs. I mean, who don't have a full-time sustainability director earning 150 grand a year or whatever. I mean, they definitely can be structured for those borrowers. And in fact, the banks who are active in this space, particularly the Aussie banks, but certain key international banks as well, that's the role that their sustainability team plays. They get in there, they help you, appoint the consultants, help you come up with the structure and the plan and stuff. And actually, they're really trying to plug that gap in the market and doing a great job of it. It's just one of those things that we often find, when a borrower is looking to refinance its debt and it's thinking, okay, this is a simple 4 to 5 week process. I've done it 100 times before. I don't need to worry too much about it. And then there's all these other new tick boxes that they have to do. They kind of, at the moment, they're kind of saying, you know what, let's do this next in 3 years time when I refinance again or something, and so I think once that balance tips a little bit and you start seeing more people take it up, you'll see a lot more of these deals kind of closing in the market.
Michelle, it's probably worth throwing to you, because how would an organization now determine an ESG strategy and targets? Because clearly, this is something that all organizations are going to do. They either have done or they will do in the next couple of years, and get the margin benefit, which I think we'll go into the secondary markets and the margin benefits. But Michelle, just in terms of what's the approach now if you're an organization that hasn't done this before?
Yeah, well, look, I think you're right. As a starting point, a company needs to have, in terms of accessing sustainable finance, a company needs to have an established ESG, strategy in place, and it needs to be something that they're, have already been committed to and implementing. You wouldn't be seeking to access sustainable finance if you didn't already have that sort of sound ESG commitment embedded in your organisation. So I guess the challenge around that is, how to actually formulate that strategy, how to come up with the targets that are meaningful and ambitious for your particular organisation. So, in the sustainability linked lending space, I think lenders and borrowers, as Stuart was saying, they really will work together to agree the targets. There may be an external consultant involved, but the targets will vary on a case-by-case basis, depending on, the particular industry you're in. But I suppose common, environmental targets, are around reducing your greenhouse gas emissions, and which those can be measured against industry benchmarks. Looking at more efficient resource use and targets around waste prevention and control, but there are all sorts of sort of industry standards that you can look to. But also when you're determining your targets, it can be useful to see how you stack up against comparable companies, looking at comparable deal points, which as the market evolves. And so you might look at companies in your industry that are sustainability leaders and look at what they're reporting on. So I think the key point though is for targets to be ambitious for the particular borrower, something that represents some genuine improvement that's a stretch, as opposed to what they were already doing.
I think that you sort of open up a very interesting point. I think, Sushila, you made in our pre-event conversation, where you were talking about that most of the secondary market doesn't yet exist. So those deal points, those understanding of the margin that you get and the benefits you get from having green loans becomes hard to see because you're not getting a secondary market around that. Is that true, Sushila? Is it how easy is it to actually know what others are doing when it sounds like it doesn't seem to be a lot of reselling of these products?
Yeah, and the reason that there's not a lot of reselling is because there is such demand from the market, from the investment markets for these products. So there's a huge amount of demand from consumers and from organisations like superannuation schemes for responsible investment financial portfolios, responsible financial portfolios. That means that those portfolios create a whole lot of a demand for the underlying instruments. And because there just isn't anything like the volume in the debt space that would be necessary to completely fill these portfolios, what you find is that people don't tend to sell them. So it sort of diminishes the price signal, perhaps, that you might otherwise see, certainly in equity space where there's a lot more to play with. And it really brings a lot of investor focus to that initial issuance point. So you get investors having heavily invested conversations with the issuers and the lenders and sometimes the advisors about exactly what those KPIs should look like, what kinds of KPIs that they would be prepared to put in their portfolio, because they know that they're going to own this bond, for example, till its maturity, and they are vitally interested that it meets the responsible investment or the sustainability standard. That means their portfolio in turn will comply with the client expectations. So that also introduces a really interesting trade-off, because they want it to be ambitious. They want those KPIs to be ambitious, but at the same time, not so ambitious that there's a chance that they won't be met, because that threatens their own portfolio's compliance with whatever standards they might want to have in place.
And particularly on the bond side as well, Shashila, I think because bonds as opposed to loans, bonds are public instruments, right? And so if you're reporting non-compliance on sustainability outcomes as an issuer in a bond context, that's the kind of thing that could end up in the Fin review taken out of context the next day. Ex borrower misses sustainability targets. Whereas in a loan context, I think there's been a lot more ambition in these, particularly sustainability linked products, because they are private instruments, and obviously the reporting is important and it has a margin impact if you miss your KPIs, but it's all private, and so it shouldn't be disclosed publicly, I guess.
And that's also why some of the most interesting instruments from the point of view, the kinds of investors that I'm mostly dealing with, which are big institutional investors, are actually instruments issued by by banks who lend to these projects behind the scenes. So you've got the bank doing all the due diligence, the bank managing the tracking of compliance and so on, and the owner of the bond, if you like, is exposed to the bank rather than to the underlying projects.
Does that and then flow into, because I mean, a lot of this is, if you like, private, but then the public side, there's a term out there talking about greenwashing. Do we see a lot of that at the moment? Corporate greenwashing?
Oh my word.
A very open question, but I'll throw it out anyway.
Probably the only thing that is growing faster than responsible investment right now is responsible investment greenwashing. It is massive. It's a huge problem. We're starting to see court cases about it around the world. There's a court case right now with the bank DWS overseas, and these are attentive to. There's one in Australia that's being brought by ACCR, one of the Australian listed gas companies. Interestingly, this idea of greenwashing is starting to be picked up, and legal action taken addressed directly to companies, addressed also to investment institutions. So there is, like any gold rush, there is a lot of cowboy-like activity in the space, and it's really important. That's one of the reasons that it's so important to be attentive to the quality, and why organisations like the Responsible Investment Association Australasia are so important in the ecosystem as standard bearers, as standard setters and certifiers.
It's interesting, actually, Cecilia, you mentioned that the case of the ACCR and the listed gas concern. I think it's been speculated for quite a while, actually, that you may be, as a director of a company, breaching director's duties by not taking a reasonable duty of, or a reasonable care to deal with ESG and climate risks, right? And so that is a potential risk for company directors that they need to start taking into account. And I think as I suppose the environmental concerns get more pronounced and severe, and the financial risks associated with poor ESG outcomes become more intense, I think that duty only gets more severe. But one thing that is really interesting in that case that Sushila referenced is that the other risk that companies and also directors individually open themselves up to by greenwashing is a misleading and deceptive conduct claim. And not to go too deep into it, but the elements to make out a misleading and deceptive conduct claim are actually quite easily made out. And there's quite a low threshold. And if you do not have reasonable prospects for making a representation about a projection in the future, then you open yourself up to not just liability for the company, but personal liability. And look, it wasn't an ESG related case, but there was a recent case, the Dick Smith case, where a company director was personally liable for $52 million himself because of misleading and deceptive claims he had made to his lender in the context of his financing discussions. And so, the next big case is going to be, a company director potentially personally liable for big dollars as a result of, potentially greenwashed statements that they made without reasonable prospects for believing that they would follow through.
And I think, these cases also just highlight that, if you're making claims around certain targets, you need robust and sound plans to back up, the claim. And in the oil and gas space, to the extent you have ongoing and, expanded exploration or, production activity that's proceeding as usual with no sort of clear indication of change, then that's, going to be hard to reconcile with your claims on sustainability.
You're on mute, Greg.
You're on mute, Greg.
I tell you, that's why I bought one of these mugs. Is there much change from a regulatory perspective on that as well? Are we seeing regulation trying to catch up with greenwashing, or is it just, and I suppose it's to all of you, Stuart, as well, is this just, we're just using existing courses of action? There's no new regulatory change that's coming through.
So,
sorry, go ahead, Sushila.
I was going to say that, there has been reference to greenwashing from the Australian financial regulators, corporate regulators, but where it's perhaps not as muscular as what we're seeing coming out of Europe. Now, what's happened in Europe is actually a wholesale adoption of responsible investment standards right across Europe. And of course, a lot of financial products, one way or another, have exposure to Europe. Either they include European securities, or they're sold into Europe, or they're European providers who are selling into Australia. So that has kind of an extra jurisdictional effect. And we would expect to see, an increasing kind of coalescence around the kinds of standards that are emerging there. But we know the regulator there, for example, has sent a letter to the chair of every financial institution that, that is part of that of the UK jurisdiction, highlighting some of the, the issues that they've found in the applications and in the disclosures. It's still emerging, so it's not yet at the stage where they're taking action, but they're certainly warning about things that they find to be unconscionable.
And I think, without sort of a robust framework around measuring and reporting on sustainability performance, then that also can, give rise to the risk of greenwashing. And I think we've seen various measures globally from, policymakers and regulators to really have some kind of framework around your reporting. I think, at an international level, the TFCD, which is the Task Force on Climate-Related Financial Disclosures, so they've established by the G20, they have developed the framework for climate change related reporting that's really seen widespread adoption. Although in Australia, these disclosures aren't mandated, but I think that will, go towards basically trying to mitigate that risk of greenwashing.
And look, just from my part, Greg, I mean, I think both of the things I mentioned before about directors' duties, misleading, deceptive conduct, that's just general, legislation that's already in place. To be honest, I can't see in this climate with this government anything more robust that specifically goes to this area. But what I would say is in the sustainable lending space is I think there are market mechanisms in place already. And in fact, I guess the key arbiters of these products, at least from a corporate borrower facing perspective, are really the banks and institutions that lend into them. At the end of the day, if your lenders aren't willing to accept what you're putting out, you're not going to be able to do a sustainability linked loan. And one thing, I think we've always had pretty robust standards in sustainability lending in this market, albeit from a smaller sample size. Particularly when you compare us to some of the other jurisdictions, even Europe. I think Europe, it's a much more mature market. It's a much bigger market, and you've got some pretty muscular counterparties over there, whether they're listed corporates or private equity sponsors, who have managed to kind of really wrestle these products into a form that they like to use. Both from a commoditized perspective, that means they can roll them out easily on each deal, but also from a perspective where they get the most out of them in terms of margin ratchet and the like for comparatively minimal reporting and external review and the like. So we've seen things come out of Europe where, for example, you may not have full-blown external review of every aspect of the loan. You might just get that on the KPI reporting, right? In Australia, generally, we haven't seen that. We've seen pretty good standards, pretty consistent standards maintained by, again, I think the Australian banks, but, some of the other key international players. And they are very, very focused on, keeping the integrity of these products. And that's for everybody's benefit. If these products start to be seen as, greenwashed and all about paying lip service without actually delivering any outcomes, then they lose the benefit for lenders lending them, because everybody knows it's a bit of a fiction, and for borrowers as well, because people say, well, okay, fine, you just sustainability linked loan, but what does that even mean? And I've actually noticed that there's been a couple of deals this year which have had some accusations of greenwashing, and if anything, I think we're getting even more conservative, or tighter in terms of criteria from the bank side. Now, again, that's important to maintain the integrity, but I suppose it's got to be balanced against what I was saying at the beginning of the call, which is also making these products accessible. And I don't actually know the answer to that. I don't know how we kind of make these products easy for smaller borrowers, SME type borrowers to access, whilst at the same time ensuring that the absolute integrity of the product. I think the only answer is kind of more standardization of the types of structures, but again, it's very difficult because they're not one size fits all solutions.
It's that natural tension between you want the market to be as efficient as possible, but you don't want people to get away with the margin ratchet, as you're saying, for doing nothing other than maybe a couple of reports. Is the margin ratchet quite substantial then?
Not in this market, no. I think the most we see is in aggregate 5, 6, 7 basis points. But I mean, look, if you're talking about $1 billion worth of debt, that is quite a lot. In Europe, anecdotally, we understand that some of the big private equity sponsors can get as much as 15 to 20 basis points, which is much more material. But
especially in the current low interest rate environment.
That's right. Yeah.
Wow. Okay. Switching topics a little bit, but it's probably staying on the same question around greenwashing. If you look at the traditional oil and gas industries, how easy is it for them to access sustainable finance? Does it even make sense that they are? I might throw that to you, Sushila, to start with.
Well, I won't speak to how easy it is for them to access it. But I will say that some of the most compelling sustainability stories for investors have included transformations. So there is a company, for example, in Europe, it's a company that exists within some of Regnan's fund management portfolios, which started out as a fossil fuel energy generator, and now it's the biggest provider of offshore wind farm energy. Companies, the whole point of specific financing for sustainability is that doing sustainability things costs money, and the funding needs to come from somewhere. And one of the programs around the EU taxonomy, one of the kinds of things that RIA standards take into account is the change, which is often much more important to some investors and some investment portfolios, because change makes a difference, and investing in existing sustainability stories doesn't necessarily make that difference. That's quite a subtle argument to make to your average retail investor, but in the institutional market, it's increasingly recognised. And so there is a whole category called transition finance, transition bonds, and that's the kind of thing that we would expect to be financed within that.
Yeah, no, I agree with Sheila on that. I think those borrowers, the brown borrowers, if you want to call them that, are actually the low-hanging fruit for these types of products. The problem is, right, if you are seen as a brown borrower, people just don't believe anything that you say about what you're trying to do, rightly or wrongly, not passing any comment on that. I mean, maybe in some cases it's justified, in others it's not. But realistically, if you have a large carbon footprint, for example, and you can show through a sustainability linked loan, ambitious and meaningful improvement, as Michelle referred to, then that is what we should be trying to do. I mean, we're speaking to a large North American sponsor who has a lot of real estate assets, and everything they do is already 6-star and as green as you can do it. And they were saying, calling about these products and saying, oh, we really want to do one of these sustainability loans, but we can't do anything better than what we're doing at the moment. And it's really hard for us to kind of find KPIs that we can show meaningful, ambitious improvement on. Whereas, mining, coal exposed borrowers, things like that, if you can show material improvement on your greenhouse gas emissions, then surely that's what this product's about, right?
I really like that low-hanging fruit analogy. I think, when you're looking at brown industries transitioning, there is that huge potential for improvement. But of course, it needs to be, underpinned by boards and senior management being, committed to meaningful change towards those sustainability outcomes. And I think you're right, there's always a level of scrutiny around these brown industries accessing sustainable finance, but I think that's a positive thing. And the more good examples that come to market, that'll only help the market develop and grow.
No, definitely. I would say, if you are a brown borrower in this space, or you're structuring a deal for a brown borrower, you've got to be squeaky clean, because people will be looking at it from every angle and trying to pick holes in what you're doing. And they're not going to be satisfied with incremental improvement. That they're going to want to see an absolutely perfectly structured loan with great KPIs, excellent reporting. Otherwise, they're just going to they're just going to crucify you. And we've seen that happen on a few transactions, actually.
It's interesting though, because to some extent, if you are a brown borrower, or you're a traditional carbon intensive industry, it's better to fix the problem yourself than if you're a portfolio player and just get rid of the problem. So Sheila, I think you made this point beforehand, and sometimes we're seeing that in the market, right, where you actually you're just getting rid of the carbon intensive parts of your business. Yeah, and we're seeing that at a number of different levels. So the push for divestment, which is primarily oriented to trying to get financial companies to exit their holdings of brown is one example of that, but it also occurs at the individual company level. So we could see, some of our mining companies, or even our energy companies, they're really portfolios, industrial investors in their own right, and they can, sell this asset and buy that asset, and over time that changes the profile, depending on the greenness and brownness of those assets, that changes the profile of the company as a whole. It's not necessarily a win for the climate when one of those assets ends up in different hands, perhaps with less scrutiny than it otherwise would have. I think we're seeing that with one of the ways that one of the gas companies in Australia is playing out right now. Yeah. A really good question from the floor. I'll probably ask you this, Stuart, and then throw it to the rest of the panel. So this comes from Amelia. Do lenders themselves need to become more literate in bespoke sustainability KPIs to encourage increased deal activity? For example, members of the sustainable finance team being better versed in sustainable practices around oil and gas flaring. So really understanding it better.
Yeah, look, I think so. I don't think you can structure these products without a good understanding of the ESG concerns. And as I said, I think, you know, the Australian banks in particular have really massively geared up in this space in the last, 18 to 24 months in particular. And they have got this capability. They're bringing people in from industry and, with backgrounds who understand this stuff, as well as other markets, as I said. I think the international banks, perhaps not all of them, some of them do have very strong presences on the ground, but some of them don't have like a dedicated ESG person on the ground. But what they do have is the institutional knowledge. So you often find when you're looking at these ESG loans with an international bank, the ESG questions will kind of go offshore to Europe or Asia and kind of come back overnight with very well thought through and understood answers. And so some of the stuff is well above my head in terms of the actual outcomes or the mechanisms that they're using. But those sustainability coordinating banks need to be able to explain all of this to the other banks in the syndicate who are going to participate in the loan from the perspective of a financier. And if they don't have that literacy in the concepts, as you say, they're not going to be able to do that, And part of it as well is, as I say, if these banks are, as they often do, holding hands of borrowers to help them structure these products, they also need to be able to explain it to the borrower and what the borrower needs to achieve.
So they've got to have the technical expertise themselves.
Definitely, yeah.
Yeah, I'd add to that. So there are groups like Regnan whose job it is to hold the hands of the investors who will ultimately hold the bonds in their portfolios. And the job is to scrutinise and try to poke holes in the sustainability story of whatever's being presented, precisely to avoid this kind of greenwash problem that we talked about. And we, it's always much better to be able to be having that conversation with the people on the other side who are structuring the deal, where they are at least as fluent in talking about the technical aspects of whatever is being described or committed to in terms of the KPIs and how they're going to be met. It's not necessarily as confidence inspiring when you realise that specialisation just isn't there. And banks have the resources to be able to do this across a lot of different customers. There's no reason not to build that expertise or the networks to be able to access that information, even if that's external.
Yeah. Excellent. Another question from the floor. What are your thoughts on the sustainable finance instruments such as green or sustainability linked loans facilitating the post-pandemic recovery? So that's tying it into what we're seeing with COVID. And I suppose also comes down to the cheapness of money at this point. Even if you're dirty, money's potentially cheap to get. Might be.
I don't think that's right, actually.
Good.
And I actually think it's becoming a problem. And again, I've got some real world experience of this, which I don't really want to name names, but I think you're going to see a number of borrowers, well, we're already seeing it, where a number of borrowers with exposure to coal in particular are really struggling to raise finance through their traditional sources. Banks are not willing to lend to them anymore, particularly European banks, Australian banks, Japanese banks. They're still having some joy with some of the Chinese banks, but I don't know how long that's going to last. And so I think it's actually, if you do not have a sustainability plan and you are not meeting kind of what people now expect from large corporate borrowers and from a sustainability perspective, particularly from an emissions perspective, I think it's going to become almost impossible for you to raise finance at any sensible price in the next couple of years. In terms of the question as to how this links to the COVID recovery, I'm not sure. I haven't actually thought about that. I do think. When the first one of these deals in Australia was done, I think it was Sydney Airport, that was early 2018. And then we did a couple more airport deals after that. in different states around the country. But then, just as things were starting to pick up in this area, kind of beginning of 2020 was when COVID hit, and actually we didn't see any more of these deals for kind of 7 or 8 months, because people were just figuring out how to live with COVID and keeping the business lights on and whatnot. I think that probably slowed some momentum, but we're now again seeing these things kind of gear up, and there should be another 10, 15, 20 of these deals in the next kind of 6 to 12 months, I would expect.
And one thing that kind of goes towards the pandemic recovery is, I guess, the S of ESG, so the social outcomes. So, social KPIs can come into sustainability linked products as well. Of course, it's not necessarily the main focus, but as opposed to a standalone social loan, but so social factors such as thinking about how that particular company might support local communities, or other sort of human rights issues, so that can come into play perhaps in that way. But to Stuart's point, I think this all just highlights the broader community expectations around sustainability being a critical priority, and companies need to be proactive in addressing and measuring and communicating their climate-related action.
I wonder if you could get a KPI away tied to staff COVID vaccinations.
Yeah, that's a tip.
Good try. And I suppose back to your point as well, is some of this comes down to stranded assets. So Sheila, you probably jumping in there, right?
I was just going to say it's true at the systemic level. Completely agree with what Michelle and Stuart have been saying. So crises are always moments of opportunity, and trying to do the same things that you did before the crisis, when you know that those kind of have a use by date that's on the horizon, may not be the most sensible strategic way forward for a lot of organisations.
Another very interesting question, which we didn't even talk about in our pre, which is very exciting. Another one from Amelia saying, what is the panel's thoughts on expanding sustainable finance solutions to the transaction banking space? So it's not just, obviously the loan side as well, but things like green guarantees, green deposits. I don't think I've seen those products in the market. They may be there, but I haven't.
No, look, I haven't seen them either. But I mean, look, definitely. I mean, the whole thing with the APLMA, LMA, LSTA principles, right, is they sound like this tome of like very complicated and prescriptive things to do or not do. They're 4 or 5 pages long, right? Like you should go and look at them. They're very digestible, lots of pretty pictures, and I was quite surprised when I first opened them up a couple of years ago and realized there wasn't actually much to them at all. But they're intentionally set out that way because, I think they're trying to provide a framework, but not be prescriptive around how market participants should actually implement those frameworks. And so, that means people can be flexible about the KPIs they choose, or the margin ratchet mechanism that they apply, even, aspects of the reporting and the external review. So, I think that the way, you would need to have some kind of framework similar to the, the sustainability linked loan principles. I think because, you've got to have some kind of standardization across the market. But, I think if you can put a framework in place that banks can work with, I think they would eat that up, because, as Sheila's mentioned, there's huge appetite for everything to be as green and sustainable as possible these days.
There's quite a lot of information freely available on the website of the Responsible Investment Association of Australasia. It includes products like banking products that are regarded as sustainable. And so obviously if you're coming from, it's information provided for the benefit of consumers of those products who are looking for those products, but obviously understanding how the consumer is seeing this and how the industry bodies evaluate these kinds of products would be useful if you're thinking about how to structure or create the products.
Another really interesting question. Obviously, we've focused quite a lot on the environmental part of the ESG. And as Catherine asks, ESG is a 3-letter acronym. Aside from the environmental climate factors, what social and governmental factors do the panel see as key in this area?
Go ahead, Michelle.
Oh, no, well, I was going to say perhaps you could talk to the G, but I touched on a little bit before in terms of the S. You know, looking at social factors, there's a really broad range, and I guess it depends on the particular business as to what would be relevant. But, you know, human rights issues, labour, standards in sort of supply chain, diversity. So there's a real range there, I would say.
Yeah, look, I think one of the most impressive uses of, I guess it's a little bit S, a little bit G, is where Carlyle, the private equity sponsor, you know, had a $4 billion facility to fund some of their portfolio companies. And of course, Carlyle owns, you know, hundreds of different companies. And their KPI was tied to diversity representation on their boards, you know, and that is a problem which people have been struggling to solve for ages. And it's actually a really smart way to do it. And, you know, I think that's a great example. Other examples of kind of KPIs that we've seen is, you know, kind of having an Indigenous Reconciliation Action Plan or Indigenous cadetships, Indigenous awareness programs. You know, G8 Education is kind of an early education provider. They obviously don't have a huge carbon footprint. So a greenhouse gas reduction emissions target is probably not what people are concerned about. Their KPIs were tied to educational attainment and OH&S factors, right? And so I think, you know, banks are and lenders, in my experience, are pretty keen to work with what the business is actually, what the business's existing sustainability plan is. And in fact, you know, the APLMA principles actually recommend that that's the case. I mean, that this is why we say that the sustainability factors need to come first, the policy needs to come first, and then you build the loan around it. So they should all be tailored to what the business is actually trying to do from a sustainability perspective. And if, you know, your business is more, from a sustainability perspective, is more focused on non-environmental factors, then, you know, I think lenders will support that as long as it's kind of consistent and you've got ambitious and meaningful targets.
Yep, agree. We deal a lot with the equities part of the market, and it's probably the S and the G that are actually the bigger factors for thinking about equities and how they qualify on sustainability grounds. Governance is critical across lending, and so we would expect that to form part of the due diligence anyway, regardless of whether or not it's a sustainability specific product. And so we don't give extra attention to that for the sustainability elements of the product. But corporate governance obviously is critical. It underpins whether or not you can expect management to actually deliver the things that they've promised to deliver, which is obviously critical in a sustainability linked loan, as it is, you know, in general, if you're investing with the company in whatever form. The social factors that we particularly are attentive to include human capital management, business ethics and culture, including all kinds of signals that you know, that the company is attentive to managing for ethical outcomes produced by its staff. That includes, you know, the kinds of questions they're asking staff within their engagement surveys and so on. And then and workplace health and safety, which sort of explains a whole raft of things. Right. That ethics and conduct one, though, takes into account a range of stakeholder issues, things like, you know, cultural heritage protections management might be part of that. Bribery and corruption might be part of that. There's a range of ways that we look at the extent to which a company is managing well for its ethical exposures.
Conscious we've got time, we've got 2 more minutes. So I just thank you so much, panel. This has been a fascinating conversation. I've learned a hang of a lot. Maybe just 30 seconds each on how you see the next 12 months evolving, both from a market as well as the type of instruments available. I'll start with you, Sushila.
Well, I'm going to talk about how I'd like to see it evolve. I would like to see many, many more kinds of corporations providing their activities into streams of lending that commit them to a version of sustainability and allow those instruments and those investments to somehow make themselves into the portfolios of all of the investors that I deal with, this $1.28 trillion dollars worth, which is continuing to grow. And I'd love it for corporates to be attentive to the kinds of frameworks that investors value in evaluating what good sustainability looks like. Things like the Future Fit Business Benchmark would be an example of that.
Thank Thank you. Stuart?
Yeah, look, I think actually we're on a path at the moment, at least in the kind of borrower-facing space, where I can see this becoming a even more active and successful market than it has been in the next 12 months. I think there is still a little bit of, I guess, uncertainty on the borrower side about how and when to implement these products. But as I said, I feel like the banks, and again, I keep referring to the Australian banks, are doing a huge amount of work in getting these products kind of in front of borrowers, you know, making sure that people are aware of what they can do, and then helping to structure them. So I think it's going to keep going from strength to strength. The appetite will still be there and probably grow, but you will see it translated into more kind of deals showing up in the papers as being completed as sustainability linked products.
Excellent. Michelle?
Yeah, I agree. I don't see the demand slowing by any stretch. And in the transition finance space in particular, I think, you know, in Australia, we're still sort of scratching the surface on that. There's such a big focus on mining and resources, but also, you know, agriculture in Australia. I think that's an area that needs support to transition. And yeah, so that, you know, sustainable finance does provide a very exciting opportunity for change there. And then just on the flip side, I also think that, you know, there'll be opportunities for governments also to, you know, introduce more policy responses to actually promote and support this market, whether it be by way of, you know, grants or tax relief that we might have seen overseas, or capital relief for banks. I think that's an area that is worth exploring as well.
Brilliant. Only way is up. Thank you so much. It was a great panel. Thank you all.
Thanks, everyone.
Thanks
for having us.
Cheers. Bye.
Bye.
Bye.